What if I told you there's a Singapore-listed company with more cash than its entire market cap, pays you a nearly 7% dividend, and controls Asia's most prestigious marina brand? No, it's not a REIT, and it's not some tech moonshot. It's a boring, but beautiful, cash machine that nobody's watching. Hey investors, welcome back to Durian Finance, where we decode hidden gems in Asia's stock markets. Today we're diving into SUTL Enterprise, ticker symbol BHU, the company behind the luxurious 1°15 Marina brand. From yacht charters to marina management, and even Singapore's largest yachting festival, this is a vertically integrated niche player with serious staying power. Quick disclaimer: this video is for educational and informational purposes only. It is not financial advice. Always do your own research and consult a licensed advisor before investing. SUTL Enterprise is Asia's only listed integrated marina operator, anchored by its premium 1°15 brand. Headquartered in Singapore, the group manages world-class marinas including 1°15 Marina Sentosa Cove and 1°15 Marina Panwa in Phuket, a top yachting destination in Thailand. Its expansion continues with 2 upcoming sites: Nirrup Island in Indonesia, positioned as a luxury getaway just 15 minutes by ferry from Singapore, and Jakarta's Navy Club, which will bring the 1°15 experience into the heart of Indonesia's capital. Together, these locations form a growing regional network that serves Southeast Asia's rising demand for luxury marine tourism. Their revenue flows aren't limited to berth rentals. In FY 2023, sales of goods and services, covering marina income, room bookings, banquets, F&B, and yacht charters, totaled 29.5 million Singapore dollars, or about 77% of their 38.1 million Singapore dollar turnover. Meanwhile, membership and management fees, which include club memberships and consultancy to third-party marinas, came in at roughly 10.6 million Singapore dollars, or 28% of revenue. And don't forget, they operate a fleet of 40 to 50 luxury charter yachts under 1°15 luxury yachting, plus venues and events like the Singapore Yachting Festival. Let's talk numbers. As of FY 2024, SUTL generated 39.6 million Singapore dollars in revenue with a 21.5% profit margin and 8.5 million Singapore dollars in net income, a 12% jump from the year before. Its PE ratio is just 7.5x, and it trades at 0.91x book value. But here's the jaw-dropper. SUTL has 66 million Singapore dollars in cash. That's more than its entire 63 million Singapore dollar market cap. Its enterprise value/EBITDA ratio is just 0.10x. That's absurdly low, suggesting the market is completely mispricing its cash flows. Operating cash flow stands at 6.8 million Singapore dollars, with free cash flow around 5.3 million Singapore dollars, yielding 8.4% FCF yield, solid for a small cap. Return on equity, ROE, clocks in at 13.1%, above industry norms, 5%, suggesting efficient capital use. ROIC near 10.9%, comfortably above its WACC, 4.2%, meaning it's generating economic profit on its capital investments. Why this is a value-laden setup? Net opportunity. The firm is literally trading at or below its net cash value, allowing investors to own the marina business for free once cash is subtracted. Asset-rich and income-generating. With high-margin business lines, EBITDA margin 35%, producing reliable dividends, is almost equal to 6.9%, and cash flow, it's more than just a cash hoard story. Ignored niche with low liquidity. Limited analyst coverage and thin trading volume means market inefficiency thrives here. It's underfollowed because it doesn't fit typical investor radar. In Graham's terms, this is a textbook net, or cash bargain scenario, something Benjamin Graham built his philosophy on. You're buying an undervalued, asset-rich company with profitable operations and dividends, yet paying less than its book value of cash. No investment is risk-free. Revenue declined 1% due to slower charter demand and travel normalization post-COVID. Being in the luxury segment, it's also exposed to macroeconomic downturns. If the wealthy cut back on yachting, earnings will take a hit. And finally, liquidity risk. Daily trading volume is low, which could lead to price volatility. So what's the final verdict? You're getting a stable, high-margin business, backed by real assets and a premier brand. That pays a dividend beating the STI average, and it's trading at bargain bin multiples. This isn't a moonshot, but it's a fortress small cap with high insider ownership and low downside. If you're a long-term investor looking for dividend yield, value, and niche industry exposure, SUTL deserves a spot on your watch list. Like if you learned something new. Subscribe for more deep dives on undervalued Singapore stocks. Como below.